I'm Anthony Rose. I'm founder and CEO at SeedLegals. I used to head up BBC iPlayer. After I left the BBC, I built a startup, sold it, built another startup, sold it, got tired of paying lawyers, and created SeedLegals with my genius business partner, Laurent Laffy, ex-VC. So in 14 and a half minutes, I'm going to tell you the 10 most important things to get right for your next funding round. So we're going to have to move quickly. So let me share my screen and okay, application window, excellent. All right, now I'm told that you can make the screen part smaller and me bigger, so you get to see a bit more arm waving, but we'll see how we go. So thing number one is get your cap table right. So the cap table, when people start, if it's a UK company, you normally start with maybe 100 shares split between the founders. If you only have 100 shares, when it comes to do your first round, that's a price per share of like £15,000. It doesn't work. So thing one, don't make more shares, do a share split, and you're going to want to have 100,000 or 1 million shares going into your first round. Again, the share split is important. Next thing is, sometimes I see founders go crazy. They've read what Facebook does with Mark Zuckerberg, where they create shares with like 1,000 votes per share for them and nothing for the investors. In every case I've seen, that needs to get undone because investors hate it. So always create ordinary shares. Everyone gets ordinary shares. Sometimes the investors want preference shares, but we'll get to that in a moment. Next thing is allocating shares to team members. So when you start your company, when you incorporate, your shares are worth nothing. The company is worth nothing. It hasn't raised any money. It hasn't traded. So you can freely give shares to people without tax issues. But once you come close to your first funding round, the shares have a value, and then you shouldn't give shares to people because they'll have a tax liability. And instead, you create a share option pool and give options to people. So the rule is, if the shares have got no value, knock yourself out, give people shares. Your CTO, the third person who joins, and so on, give them some shares. But as you get to your first funding round, now start giving out share options, which takes me to the next point, which is to create an option pool. So an option pool is just a reservation. It's not actually anything. And its purpose is to pretend that those shares exist so that when you calculate the price per share for a given valuation for later investors, it's as if those shares had existed. There's more to say than 15 minutes here allows, but our stats on SeedLegals show that the people in the UK companies typically create a 10% option pool. The US is sometimes higher, but this lets you give options to your team members very easily afterwards, and you're going to create an EMI option scheme to give shares or options tax efficiently to your team, and you can do that on SeedLegals. So next thing, the UK startup ecosystem, as you no doubt know, is fueled by SEIS and EIS investors. This is angel investors looking for their tax discounts, so that if things don't work out in your business, you can still see each other over Christmas because they've written off 50% of their investment when they invested, and if your business fails, they write off their investment as well, and if your business succeeds, they pay no tax if they keep their shares for 3 years. So you don't have to get advance assurance, but investors will often ask for it, so it's worth doing because it's often the difference. If you can tell your investor, I have my advance assurance, it's the difference between them saying, I'm in, versus come back when you've got it. Next thing, valuation. So when you're an early stage founder and you're now talking to investors, what valuation are you going to ask for? You've spent a few weekends on your project. Is it really worth £3 million at the moment? Or is that crazy? You've only spent £10,000 on it. What's the valuation? So there's several ways to try and work out your valuation. Number one is read TechCrunch and then take a 0 off the end, because those are crazy US valuations. Number two, go to UK Tech News or other publications. Every publication says how much companies have raised, but they don't tell you the valuation, so that's no good. The next thing is take a spreadsheet and model your future revenues. And I think investors look at that, I certainly do, with it's BS, because people make up these numbers. Oh, I'm going to do 100 million in revenue in 4 years' time. I'm going to be a FTSE 100 company. Very nice, but chances are it's nonsense. So I discount those spreadsheet modeling. And instead, what's interesting is the data-driven approach, where I've seen that on SeedLegals, companies dilute a median of 15%. And this makes it really simple, because it means that you can take, so here's the, if you can see my cursor, 15%. So if your investors are looking for 30% of your business, send them to the SeedLegals resources data section to show that this is bad. And if, on the other hand, you're trying to raise 50K at a 2 mil valuation, that's fine, but you might be leaving money on the table, or it might indicate your valuation is too high for the stage you're at. But if you're selling or diluting 15%, it's actually quite easy. You just take the amount that you want to raise, multiply it by 5, so the investors are getting 1 in 6 of the total capital after the funding round, 16%, pretty close to the median. Now, that then leaves you the question, how much do you want to raise? And for that, I see UK funding rounds falling into a very similar pattern. Thing one, founders put a median of £26,000 of their own money into the business first, because nobody will invest just on a PowerPoint. So you have to build something. Then you might raise 50K, 70K from friends and family. Then you might raise 150K or 200K SEIS. Then you may raise 500 or 700K in a seed round. And then you might raise a couple of million at a Series A round. So you don't need to do 4 of those. You might skip one. You might even skip more. But my goal, I think, is to raise investment 3 times, each time at 3 to 5 times the valuation of the last round, such that after 3 rounds, you either are now making money and you never need to raise again, or you've made enough and you can now exit the business and everyone, it's a win. And if you raise 3 times, diluting yourself by 15% each time, that's 0.85 to the power of 15, and a 10% option pool, the founders still have more than 50%. So the numbers work. But there's something new, which is, in the past, you would raise enough to last you 12 to 18 months in this go big or go bust cycle. So you raise lots of money, you're insanely happy, you've got all this money in the bank, and then slowly the money goes down, you start hiring people, you haven't got revenue, and you can see the train coming to the wall. And this is very, very stressful. So, but why does it have to be that way? Why can't you just raise in a more agile way? And that's because the cost and time of going to a law firm was so great that you would only repeat this infrequently and try to raise a lot each time. But now on SeedLegals, what we see is the rise of agile fundraising. So people using our Seed Fast product, that's a convertible loan note effectively, to raise ahead of a funding round. Then those will convert in a funding round, and then you do a rolling close round so you can top up afterwards. So you might want to raise £200,000, but you've got 100,000 lined up. Instead of waiting, you can close the 100K and then top up afterwards with what we call instant investment. So welcome to Agile Fundraising, and more than 70% of rounds on SeedLegal now are rolling close rounds, and I'm delighted because it means founders can raise fast and then top up later. So very quickly, when you talk valuation to your investors, always talk about the pre-money valuation. That's the valuation before you add on the amount you're raising, and explain that it's pre-money so that there's no ambiguity, as opposed to post-money when they would get a different equity. Always, I think, prepare 2 versions of your pitch deck. One of them with just the team, the product, the problem you're solving, and you can freely share that. And the other version with your business financials, their valuation and so on, and you only share this one-to-one with investors who are interested, so that you don't have multiple valuations and confidential business projections that people can use against you in years to come. So you're now ready, you've figured your valuation, you found some investors, they're interested, you're going to get on SeedLegals and send them your term sheet. And when you do that, there are some things to consider. So a funding round is a term sheet, then a shareholders agreement and articles, hundreds of pages, or a couple of hundred pages of legalese. But actually in a funding round, there are only like a half dozen or maybe a dozen really key things that you and the investors want to agree. So what is a funding round? It's really a set of legal documents that set out protections for the investors, so you can't run off and dilute the hell out of them later when you feel like it, and protections for you, so that if they claim against the company, they can't claim against you, or only small amounts, and so on. So let's very quickly go through the key ones. Thing number one, founder vesting. So if you leave the business, the investors want to see that you're going to give back some of your shares, because otherwise, they invest in your business at £1 million valuation. You go, I'm rich, I sell, and everything they've invested in disappears. Or if your co-founder leaves, what if the co-founder leaves and they keep their shares? Your company's uninvestable. So you want to have vesting in place, and you do that with a founder agreement, and then reiterate it in your deal documents to say, if I leave anytime in the next 3 years, I have to give back some of my shares. So that's thing one that investors will look for. Thing number two, if investors want preference shares, it means on a sale of your business, they get their money back first. So it's not a big issue, but it's something to consider, because if you sell at 100 million and you've raised 5 million and given the investors preference shares, they get the first 5 million back, you split the remaining 95. Fantastic. But if you have a so-so exit and you sell the business for 5 million, like an acqui-hire, and the investors get their first 5 million back, you get nothing. So preference shares have a big cost to you if you have a low value exit. The good news is in the UK, investors usually get ordinary shares for their SEIS and EIS, so this doesn't apply. The next thing is drag along and tag along. So this means very quickly that drag along means if you sell the business, any minority shareholder is forced to sell their shares, rather than they can hold out and hold you ransom to pay the millions for the 3 shares they've got. And tag along means that a minor investor, if you sell the business, can get the same rights and value as the bigger investor. So these are things that you really want, the shareholders and investors want, but you as a founder also want drag along, because you don't want to be held hostage by a minor shareholder. The next one is the company's board. And there, of course, the founders, you want to dominate the board. You want to have, let's say, 3 directors maximum, of which the founders can have 2. Don't go nuts and make a board with like 7 people in your first round, because they tend to grow with time and you want to keep it small and tight. The next thing is board approvals. So the company governance is all about who and how who needs to be involved in making decisions. Do the investors make decisions? So what you want as a founder is day-to-day company decisions you just want to make yourself. You want to buy a new coffee machine, you don't want to go and ask the investors. You want to hire a new marketing person for £200,000 a year, and you've raised £150,000, well, you probably should ask the investors, or at least seek board approval, because you're going to bankrupt the company quickly if you do that. Or you want to sell the company for £1, well, the investors are definitely going to want to know about that. So company governance is all about setting things up so small things, decisions you make yourself, bigger ones involve the board, the biggest, most important ones for investors involve the investors as well, and that's your board and investor consents. And the last thing is the warranties, and the warranties are when you raise money, you're promising the investors that certain statements you've made are true. And those statements go into the warranties and disclosure letter. And it's also part of due diligence. So most founders forget that. If you're raising from friends and family or, early stage angel investors, they won't know, they won't care. But as soon as you get to a pro investor, they're going to want to dive into your due diligence. They're going to want to see that the company owns all its IP, that there are no taxes owed, that the founders have assigned all of their own intellectual property to the company. And the first time you do this, it's a big shock. I mean, the first company, when I did that, it took me about 3 weeks to ruffle through shoeboxes and collect all the papers. It was a nightmare. The second company took me about 3 hours, and on SeedLegals, it's all on SeedLegals. It took me about 3 minutes to go share these documents, my founder agreements, my IP assignments. So you want to get that ready and go through that yourself to make sure that anytime you hire somebody, you've got agreements with them. So you have an unbroken chain of ownership of all the intellectual property assigned to the company. So I think we've got to 15 minutes exactly. Hit me up, Anthony@seedlegals.com, for any questions. I will stop screen sharing and get back to video. And so I can't believe we did like the entire thing for your first funding round in 15 minutes. And now, before I get cut off, let's see if I can pick up any questions here. So if I have 10 minutes, I'll look at that in a moment. So let me see if I pick up any questions. I don't see any questions. If anyone has a question, pop it in here, and I'll see what I can answer. Do you think VCs will need to change their strategy with agile investment? That is a very good point. So, VCs, the difference between angel investors and VCs, and this is really important because when you start your business, you're raising from angel investors, and they're looking maybe to get, if you can give an angel investor a 3 to 5 times their return in a couple of years, that's awesome, because they're going to get, 0% interest from the bank right now. So 3 to 5 times return is amazing. They'll love you. A VC, the way they work is they make most of their returns from maybe 1 in 10 investments, and they want them to be a unicorn. So VC, perversely, would happily play a game of poker where 90% of their investments make no money or go bust or make a small amount, and 1 in 10 so-called returns the fund. So for a VC, it's really, they want to see you being huge, whereas with angel investors, they just want to see you making a great business. So you have to think carefully as you get to VC, Series A stage, typically, that everything changes, that you need to show a much bigger vision, a much bigger market. But if you try and do that too soon, you can start aiming too high, and you spend all your money building a Tableau data thing and a B2B and a B2C and all sorts of stuff, rather than just focusing on getting to cash flow break even or profitable quickly to have a vibrant business. So VCs and angels look for slightly different things. All right, when would you recommend using a convertible note? Have you an opinion on the YC safe? Okay, so a convertible note is investors give you money now, and it converts into shares in your first round or your next round, just like the Agile Fundraising. But in the UK, where investment is fueled by angel investors getting their tax breaks, those aren't compatible with convertible notes. So convertible notes are not very popular in the UK, but there's an alternative called an advanced subscription agreement, which is actually very similar to the Y Combinator SAFE. And on SeedLegals, we call it a seed fast. And they're insanely popular. So this is where, let's say you want to raise 200K and you find somebody this weekend who wants to raise 10K, you can issue a seed fast. They give you the money and it will convert later. And these are really good things to do. But a couple of things to remember. In the UK, they have to convert within 6 months for the investor to be able to get SEIS or EIS tax deductions. If they don't need SEIS or you're not in the UK, 6 months is not a problem. The other thing is, my suggestion is if you might want to issue no more than about 1/3 of the total amount you want to raise in these convertible notes, because they will need to convert later. If you want to raise £200,000 and you issue £200,000 of convertible notes, when are they going to convert? They're going to stick around for ages. And, so the idea is they're meant to be short-term things that convert later. Now, the Y Combinator one, by the way, is very dangerous, and I urge caution. What happens is, if you're raising, this is a very technical thing, so bear with me. Let's say I'm raising with a safe or advanced subscription from you, and I say, your convertible investment will convert into equity at a valuation to be determined in my next round, but I'll give you a 10% discount because you're coming in early. That's great. And on SeedLegals, that's exactly what happens. If you're raising in your next round at £1 million valuation, your advanced investment will convert at a £900,000 valuation, so you get a bit of upside. The Y Combinator safe note says it will convert at a valuation that we agree, but minus any other convertible notes that we do. So the idea is, if I then go nuts and create more convertible notes or safes, the valuation actually decreases. So you have to be really, really careful that you can end up giving away a lot more equity than you had planned. So you want them to convert at a pre-money, not a post-money valuation. Sorry for getting technical so early in the morning. Okay, from Alexandra, what's the most common mistake you think founders make when raising funds? Great question. I think maybe starting with too high a valuation. So the advantage of a high valuation is, of course, you give away less equity. You've got more equity. It sounds cool, right? You're raising at a 10 mil valuation, but there are two problems. The obvious one, which is if your valuation is very high, your investors are less likely to bite. They're going to spend more time drilling down on the valuation. You're going to lose some of them. In the UK, if your valuation is more than £2 million, there is an assumption that companies in that range already have customers and revenue. So if you don't have that, and you're now approaching investors at 2 mil valuation, it's like you've popped in at senior school, but you're really at junior school grades. So there's a mismatch, and they'll tell you to come back later. The other problem, and this is often in crowd rounds where the investors are less discerning, companies raise at a really high valuation, but then when it comes to their next round, now, the Pandora's box is opened. You've said you're going to do all of these amazing things. Investors bought in at your crazy valuation, and now cut to a year later, if you're unable to deliver that vision, then your valuation might be cut down to what is now reasonable at that stage. And that is a down round. And a down round makes everyone unhappy. And if your investors have anti-dilution shares, it means you have to give them more shares out of your own pool to top them up. So it's a very expensive mistake. So I think when I see a founder that raises a too high a valuation, I see that as a red flag, and I know that they're going to come back some months later with a more realistic valuation. All right. What is different with high capex businesses, says Thomas, when you raise money? So that's a really interesting question. So most startups, of course, are SaaS businesses. You're building a mobile app, or you are doing a food delivery business or something like that. And the idea there is your classic lean startup, MVP. You're going to raise just enough to get you to the next milestone. Then you're going to have a higher valuation and raise more. But what if you're building an energy plant or a building or something where you need lots of money up front? And actually, that's kind of almost what traditional businesses used to be. You'd borrow lots of money from the bank, build something capital intensive, then make a predictable revenue stream from that. You're going to build a new office block, you're going to rent it out, you're going to borrow money. If you do have a capital intensive business, and by the way, many med tech businesses are like that because they have to spend years getting regulatory approval after they've developed something that works, and only then can they find a market and get revenue, you now need to find a particular class of investors. It's often called patient capital, or investors who will follow on. So this is going to be a subset of all the investors, and of course it's a much bigger bet for them, because what I see is in the US, investors will often make big bets. Oh yeah, we'll own the world, here's millions. In the UK and Europe, investors will invest and would like to see the company get to cash flow break even, if not after this round, at least after the next round. So investors don't like it, or it's harder to find investors where they see their money get sunk and then more money gets sunk and more money gets sunk. Obviously, it's not impossible, otherwise there would be no big things ever created, but life is definitely more difficult. All right, so high capex scooter business, right? So scooter businesses are actually a very common business. And in fact, we have at least one company on SeedLegals now looking for investment to buy scooters, to rent scooters, and there, in a sense, that's a lower risk because it's a well-known numbers business. You can already look at the numbers from an existing business and see the return on investment on a scooter is N days. Where it gets more difficult is if you want to build some new power generation thing, which is unknown, right? So, question from Rick, should a US founder consider starting up in the UK or EU? Great question, and by the way, vice versa. Often European or UK founders say, should I start in the US? And my answer is two parts. Number one, investors usually like to invest in things close to them, not only in the same country, but often the same town, even in COVID days, because they understand the legals in that jurisdiction. So my suggestion is, unless there's a really good reason, like you got into Y Combinator and you need to shift to the US, incorporate in your country. And why? Because there's just less friction from the investors who are likely to invest in you. But the other reason is, for me, whenever, I see many founders on SeedLegals, and what I'm always looking for is the founders that are laser focused on success. And success is all about building something that customers want. And only that. Anytime you're doing side things, these are diversions. And so if you want to incorporate in the UK and you're a UK company, it's going to cost you £12 and about a half an hour on Companies House to incorporate. If you want to do it in Delaware, you're going to spend months trying to figure it out and thousands on US lawyer fees. All of these are a diversion. So my suggestion is, start simple, focus on the key problem, which is finding customers and building your team, and just everything else, spend as little time on that as possible. All right. So, by the way, yes, if you do incorporate in Delaware, Stripe Atlas is a great solution as far as I understand it. I think that is it for me. I think I'm well over my 15 minutes. I don't know what happens afterwards. No one's cut me off. But, okay, I'll go with Eric's question. In your opinion, how's the landscape changing? Is it easier to get funding today compared to a few years ago? Great question. My take is it's dramatically easier to get funding. I mean, when I started out many years ago, I did my own electronics business. There was no such thing as, seed funding. I had an expectation. I had to fund the thing myself and get profitable very quickly, or I wouldn't have a business and I would have to get a proper job. Now, there's an expectation that you have an idea and you will get funding. And in the UK, particularly with the government tax incentives, you just need to go find investors. If you're a UK or French or Irish company, you can use SeedLegals. The legals part is very inexpensive and easy. So it's really convincing people to give you some money to get your idea to the next step. So your challenge is finding investors, and that is about creating a compelling pitch deck and finding investors, but it's definitely easier than ever before. And even in COVID times, if your business, if you can show investors that you are either taking advantage of COVID or unaffected by COVID, business as usual. So, if you're looking for funding, do not procrastinate. Some people think, oh, I'll wait for times to get better. Firstly, it's clear times are not just about to get better. The light won't just get switched on again. It'll be a slow burn over maybe a year or more. And even if you do wait, guess what? The other people who are waiting, when things get better, they will all be trying to approach investors. You're much better off showing how you've got a business that's taking advantage of COVID. You're better than others, and go hit up investors now. And on SeedLegals, we published some data that shows actually in May, things dipped fairly significantly, but they're back. In fact, August has been a record month for us. We had over 100 rounds opened on SeedLegals in August alone. So things are back to really pre-COVID levels. So if you are looking to raise, show that, maybe investors are looking for you to get to cash flow break even sooner than previously. So maybe some of the bubble of excitement is lost, but that means you have to work harder to show that you'll use their money to get to profitability sooner, and you'll have a business that works online, remotely, whatever it might be. But then do not wait, because procrastination for a founder is, it means you'll never get to the next step. All right. So from Eric, can you use a SAFE after already having a round where shares were priced? Or can you use a SAFE or a convertible note or a seed fast only before a round? Great question. So a convertible note or a SAFE, which is the US version, or a seed fast, which is our UK SeedLegals version, lets you raise money now, which will convert into shares in your next round. Usually it's used before your first round, because in that model, you don't know your valuation. You've got a PowerPoint, what's your valuation? Is it £500,000, £1 million, 2 million? So there, you might be better off raising without deciding the valuation, get money, get traction, get valuation decided, close round. But there's no reason you can't do that, rinse and repeat. So after your first round, maybe you now want to top up some more, but you don't want to decide your next valuation because you've raised at £1 million valuation. 3 months have gone by. You can't say it's 2 million. Nothing's changed that dramatically in 3 months. You don't want to continue to say it's 1 million because things have changed. So maybe a convertible note or a SAFE or seed fast is the perfect vehicle before your next round as well. So we look at it as a bridge before your next round. Okay, let me see if I can keep going. What do you think of the rolling funds and venture debt? So from John, interesting question. So, funding VCs themselves have to hit up investors to put money into their fund, and they normally raise a fixed amount of investment and then invest that in a number of companies, and then invest in the following rounds and the following rounds as well. And after they've used up all their investment, then they go start a new fund. So you'll see there's Seed Camp 4 and there was Seed Camp 3 before it. But there's a new class of fund called a rolling fund, exactly like I said with you as a founder being able to top up. Rolling funds let the VCs top up. And this is a new trend, whether it's a fad or it's the next big thing. This I don't know. I don't think it makes any difference for you as a founder, whether the fund has got a fixed amount or a rolling amount. You just want to get them to invest in you. So let me scroll back and see if I can find any other questions. So thanks for Johan to say something I should have found out before my round. All right, so let me take a look if anything else. I think. All right, so question from Christopher. Have you seen a VC doing a big SAFE and or a big convertible note? And the answer is for sure yes. So for a VC, it's a really great point. When you do a convertible note or a SAFE, it's usually a very light touch set of legals that says, you give me money now, I will give you shares later. When you do a funding round, there's a lot more detail about the rights of the shares and the investor consents and all sorts of things, the board governance. Now, when an investor invests, the VC, they often have a lot of detail they want on those rights. And those usually come in the shareholders agreement and the articles, and a lot less of it in a convertible note or a safe. And for that reason, VCs often want the legals of a funding round because they get all their protections there rather than a promissory note in a sense for later. So for example, they might in a funding round have investor consent on certain company decisions, but a safe note itself wouldn't have that level of detail. So they would prefer the funding round. But sometimes they get round that with a side letter or additional terms in the received fast or the safe to give them these additional legal rights that they might want. So, you'll find that funds will more likely want a funding round, but hey, you're in the driving seat, so you, if at all possible, will figure out the things that work for you. All right, from Tim, founder vesting. You mentioned buyback of a certain percentage of shares. What's the typical amount of shares you buy back up to protect the remaining shareholders? And thanks for the nice note on the session. So very briefly on vesting, it's quite fascinating. So there are two standard vesting patterns that you see: 3-year straight line vesting and 4-year with a 1-year cliff. So let me explain what that means. So let's say a couple of founders get together. You incorporate your company today and you start working on it. 3-year vesting means if you leave any time in the next 3 years, you have to give back, sell back to the company at like a penny a share, the fraction of your shares that have not vested. So if you stick around for 3 years, the shares are all yours. If you stick around for 1 year, 2/3 of the shares you have to now give back, or for technical reasons, sell back at a penny per share. So that model is essentially rewarding you for the time you put in. The more time you put in, the more shares you get. And it's a bit like you're getting the shares in lieu of salary, because in the early stages, the company's got no money. So the longer you put in, the more shares you're entitled to. When it comes to funding round, investors often ask for a different pattern. And what investors want is they want the founders to be committed to the company. If they're investing in a few founders who got together a few years ago, they know that often founders split up. And my data on SeedLegals shows that maybe 1 in 10 times one of the founders disappears. They don't get on, they don't see eye to eye, they need to get a day job to pay the rent. So their investors might ask for a longer vesting period, 4 years, and what's called a 1-year cliff. So if someone leaves in the first year, they lose everything. So it's like a high stakes game of poker. And I see this quite frequently when an accelerator or an incubator makes an investment in a couple of young founders. If they split up and they leave in the first year, they lose everything. And I think that's probably actually a good, well, it's a double-edged sword, because on the one hand, it really persuades them to stick together and avoid somebody leaving after 2 months and still owning a few percent equity in the company, even though they just gave up. That's not really fair. On the flip side, if you've put your heart and soul into the company for a year and circumstances change and you've got to pay the rent or whatever it is, and you have a 1-year cliff, you lose everything, that seems unfair as well. So that's one of the key things you're going to have to figure out. And actually, I suggest that when you incorporate, you do your founder agreements, if you're in the UK or France or Ireland, on SeedLegals, and you create a vesting schedule with 3-year vesting from incorporation. Firstly, that protects you as founders. But secondly, when you do get to your first round, if you don't have vesting in place, your investors will very likely push you to their preferred vesting schedule with a cliff, as opposed to you telling them, hey guys, I've already got vesting in place. I'm 1/3 vested. I'm not going to change that now. So you're better off doing the vesting yourself. So I'll take one more question and then I will wrap up, and I'll do from, so thanks Tim, I'll do from Rolandus, which is it a good time to go looking for investors when early customers start buying your product, or evaluate product longer and have more momentum? And I think that is a great question to wrap up on, because that actually summarizes funding in general. So, you know, the problem when you have, I'm sure you've all, when you're going to talk to investors, the best time to raise investment is always later. You know, if only I could wait another 3 months, I'd have my app in the App Store. Oh, if only I could wait a bit longer, I'd have customers. Oh, a bit longer, I'd have revenue. Oh, a bit longer, I'd have more revenue. So you're always going to, of course, if business is good, be better in the future. And of course, if business is not good, I don't have many users, I need to work on some more features, let me get the next release out, or let me get my next version of my slide deck. So it's always better to raise later. But of course, that doesn't work because you've never got any money. You need money now to get developers to get to the next step. So everything in a funding round is about raising money today to get to what I call, you know, the next step, which is raising 3 to 5 times the amount at 3 to 5 times the valuation, doing that about 3 times, such that after that you're good to exit or you don't need to raise again. In the early stages, the problem that you're going to have is that investors are going to say, "You're awesome, I love what you're doing, come back later." And the problem is that every step you get to, they say, "Come back later." So it's not really any good because you need to raise money. So the first thing is, you know, when should you raise your very first round? So my business partner reminds me, you can't own more than 100% of your own company. So if you're funding the company yourself, you have to initially, because no one's going to invest on a PowerPoint. But after a while, you know, your partner is going to notice you're putting £10,000 a month into the something, and they're going to ask questions. Why aren't we paying the mortgage? What's this thing that's eating all of our money? So at some point, firstly, you can't afford it. And secondly, it's more efficient to use other people's money than your own money, because you're just putting more money. You don't get more than 100% equity. So the point to raise money from external investors is when you can justify the valuation that lets you raise as much as you need at selling or giving away no more than 15%, ideally equity. So that might be to get to £500,000 or more valuation, and you can now raise 50, 100, 200,000 pounds. And then you're going to repeat, and at each point, you're only really going to want to raise when you've got the high enough valuation to get enough investment to get to the next step. And of course, persuade investors that now is the time. So maybe the short answer to your question, Rolandus, is that it's all about persuading investors that you should invest now. The comeback later isn't helpful because there's always going to be a later. And that means in your pitch deck, it's to try and create the time imperative that there's, you know, now is the time. And I think actually that reminds me there are probably 2 good times to raise and 1 bad time. So imagine that you were developing your products and you're several months away from launch. I think that's a good time to raise. You're raising based on the vision, the hype, the possibility, the dream. You know, we're going to have this app that uses blockchain to trace coffee beans, whatever it is. No one knows if it's going to work or not. You're going to raise a modest amount because it's high risk based on your vision and your team and so on. Later on, if things go well and you've got traction and you're showing revenue and customers and month-on-month growth, that's a great time to invest as well, because investors can see things are growing. The difficult time is, in fact, right after launch, because it's almost always the case that things do not go well after launch. It takes a long time to build up traction, and launch is often a bit of a downer. I often look at people who say, yeah, we've launched, and you look in the App Store, you know, in the Google Play, well, you can see it's got 18 reviews, or in iTunes 5 reviews, and 4 of them are the founders and their friends. So that's a bit of a downer. So sometimes people say, I'll raise enough to get me to launch, and then I'll raise right after launch. I think that's a dangerous strategy, because launch is kind of when you open the box and the dream is revealed. And if you're looking to investors then, and they go, dude, you've got 5 app reviews, then why would I invest? So my aim would be to raise before launch enough to get me well past launch, to get to some level of traction, so that, and the ability to iterate, maybe tweak, pivot, before I need to raise again, and avoid the dangerous bit in the middle. So I will draw that to a close. I think that has been a 45-minute session, which is meant to be 15. I think it's recorded, so everything will be online. Any questions, please hit me up, Anthony@SeedLegals.com, or head over to the SeedLegals website, where there's a section Resources Data. It is UK-centric, but a lot of it is global, and there are articles on the amount of equity to give away, the size of your option pool, how many shares or options to give to advisors, and a lot more resources to build your business. Thank you very much, everyone. It was great, and thanks for the wonderful questions.